Hi, I'm Luke Alexander, President and CEO of Newcore Gold. Newcore trades on the TSX Venture as well as on the OTCQX in the US. Newcore Gold, we're advancing the Enchi project in Ghana. It's a district-scale exploration project that's fundamentally underpinned by very robust economics that we outlined in a PEA in 2024. We are in the process of drilling on our project at the moment. We've increased our drill program to 35,000 meters, as well as we're advancing the PEA from PEA to a PFS, which we're expecting to get out in the first half of 2026. Motivation for that is we see a real re-rate for the company as we de-risk the project towards a PFS, as well as a lot of exploration success that we've been having.
Look, good to see you. Been a while, but so it's time for a catch up. Also, you're doing something rather unusual in the space. You're raising money. Well, you raised money, I should say.
Well, we raised money, yes. So we went out for a $12 million raise at the beginning of February. That was on the back of a very productive Indaba that we had, then stopped in New York on the way back, and had some very strong interest from a couple of very large institutional investors out of New York. We then launched a $12 million financing. That was quickly oversubscribed, so we increased it to a $15 million financing so we didn't have to cut investors back too much. That was about 90% institutionally backed, so very strong support. And the stock today is trading up about 35% since we announced that financing. So I think there probably was a little bit of a financing overhang in the market, but ultimately I think the stock being up is a recognition that the company is now incredibly well funded, with the 15 million plus the cash that we had in the bank, as well as warrants that are currently in the money. We've got over $20 million of cash and cash to come in. So very well funded to execute on a very large drill program. So we will have a huge amount of news flow this year. So great to have that, that financing completed, but also to have new deep-pocketed institutional investors come in, as well as very strong participation from our existing shareholders. So recognize that it's a tough market out there for a lot of, companies, especially on the exploration development side. But I think what we're seeing as a trend in the market is the money is starting to funnel to the quality projects that are backed by strong management teams. And ultimately, I would put Newcore into that camp. Over the last few years, we have been continuing to move the project forward despite it being a difficult market. And I think what we're seeing is that, that work being reflected in the market today. And ultimately, that culminated in us raising $15 million and now being able to build on all of that work that has been done over the last few years and ultimately aggressively move the project forward over the next 12 months.
Well, I think it comes down to that. It's aggressively moving something forward, because we've looked back over the last 12 months. I mean, exploration stories are not getting rewarded. So you're delivering more than just additional drilling here. So what are the primary objectives?
That's an interesting point you make, and I would agree with that. Over the last couple of years, and we were an example of that. We put out great drill results. Over the last couple of years, we had some of our best grade meter intercepts ever on the project, and it really didn't get rewarded from the market. We point to some drill results that we put out at the end of January 30th, if you're interested in looking at those results. And, we released those to the market, 1.85 grams over 62 meters from surface within the oxide transitional zone. So really nice intercept within that same drill hole, 75 0.75 over another 60 odd meters. And then within that initial intercept, we had over 8 grams across 10 meters. So nice high grade within it as well. On the back of us putting that news release out, the stock was up about 14%. That was the first time in a couple of years that we had seen real kind of hand-to-wallet exploration buying, let's call it. We put out good results, and the stock, reflected those results. It was up kind of 10 to 15% on the back of that. So we saw that as, an opportunity for us to, again, increase our drill program from 10,000 to 35,000 meters with the view that there's a huge amount of exploration upside and torque within the company. And, by getting out there and getting results out on a monthly basis as we explore across the project, we will be able to hopefully create that outsized return for shareholders by getting by getting that drilling completed. So that has, changed our view a little bit in terms of aggressively drilling on the project. But fundamentally, we've got a project that we're taking from PEA to PFS that has extremely robust economics. And by de-risking it through that process, we ultimately see a multiple re-rate for the company. You look at PEA stage projects, they'll typically trade around 0.2 times the NPV of the project. You start to look at, PFS stage projects, they'll trade anywhere around 0.4 to 0.6 times. We can get into kind of where we're trading today and some of the multiples if you want, but we see a multiple re-rate just by taking the project through that process. And then on top of that, we've got that district scale exploration, which we're starting to aggressively go after again.
Okay, well, let's look at that, because it's really important to understand the type of drilling that you're going to be doing. And obviously moving from PEA to PFS, you're going to want to be able to put the kind of good stuff in there. So can you talk about how you're allocating your budget between infill drilling, step out drilling, and any kind of new target drilling before the kind of PFS comes out?
Yeah, so if you look at the initial 10,000 meter drill program that we announced in Q3 of last year, the bulk of that, or almost all of that, is focused on resource conversion. We have been pushing a few of the holes deeper, and we've been targeting some parallel type structures that connect to the main structure. But really the bulk of that drilling is focused on that, call it infill resource conversion. Our goal is to take our 740,000 ounces of indicated today and increase that to 1.3 million ounces of indicated. And that's from the 970,000 ounces of inferred that we've got. So we're well on our way with the 10,000 meters that we've released to the market thus far to getting to that kind of 1.3 million ounces of indicated. With this additional 25,000 meters, a portion that is focused on continuing to convert ounces, but then we are allocating a large portion of that to resource expansion drilling. So that's a combination of a few things. One, all of our deposits do remain open along strike. So systematically stepping out and looking to add ounces along strike, which would then ultimately expand the overall mine life, is something that we're focused on. Secondly, we've then identified some parallel structures that we're focused on, as well as we have previously drill tested areas. So we've got 4 areas that we've previously drill tested, put anywhere from 2,000 to 5,000 meters into those areas, made initial discoveries, but don't have enough drilling completed in those areas yet to ultimately wrap a resource around it. So those are areas that we're going to go back to, or some of them will go back to do additional drilling to look to grow the overall mineral footprint to then potentially wrap ounces around those. So those are 2 areas, along strike, previously drill tested areas. Thirdly, and something we're extremely excited about, is the opportunity at depth. So if you look at the average vertical depth of the pits that constrains our resource today, it's only down to about 75 meters. If you look at a lot of these greenstone hosted deposits along the Sefwi-Bibiani belt from us, you've got, where you see a lot of them really grow in size and increasing grade is as you start to drill deeper. Looking at Chirano sitting at 5.5 million ounces, Bibiani at 6.5 million ounces, Newmont's Ahafo project at 20 million ounces. A lot of those are where they've identified these high-grade feeder zones. We've done limited drilling deeper down, and that's something we're excited to follow up on as well. We've identified a number of areas across the project where we've got these high-grade feeder zones, and going back to those areas, doing additional drilling with the goal of expanding that overall, resource is something where we think we can create a significant amount of value for shareholders as well. So just to recap, stepping out along strike, back to previously drill tested areas, including some of these parallel structures that sit next to our existing resource areas. And then that opportunity at depth is something we're excited about. It's important to mention, Matt, when we talk about opportunity at depth, we're still only down in a lot of these areas, down at kind of 200 to 300 meters below surface. So these are, relatively speaking, shallow opportunities. But for us, given our current, resource sits within 75 meters of surface, we still refer to those as deeper drilling. So we're excited on all of those different fronts, and a big portion of this additional 25,000 meters is going to be focused on all of those different exploration strategies.
Okay, and would you kind of classify the bulk of this mineralization as oxide? I mean, because if you're talking about 250 to 300 meters, are you hitting kind of sulfide at that level? Because I mean, what are you seeing at Chirano, for instance? What does that look like?
Yeah, on our project, the oxidized material will range anywhere from 20 to 100 meters. So we have very large oxide zones on our project, and that's one of the things that differentiates our project from projects to the south and to the north, is we do have these very large oxidized zones, which is one of the reasons why our project is so amenable to a heap leach operation. As you obviously start to get below those areas, you start to get into the sulfide material. So yes, that deeper drilling and the higher grades that we're looking at within that deeper drilling are primarily within the sulfide zones. But it is important to, again, that first exploration strategy I talked about, stepping out along strike, again, is obviously focused on that near surface oxide transitional material, which would then expand and extend the overall mine life for the heap leach operation. What you would then expect is, as we grow the overall size of the sulfide resource down the road, let's say in years 5 or 6, you could then look at putting in a CIL plant, fully funded from cash flow from the heap leach operation, to then start to process that sulfide material, which would then create a significant step change in terms of the overall production profile for the company. So, we've got lots of near surface opportunity to expand resource, but yes, the deeper drilling that we're referring to, and those feeder zones that you see at Chirano and Bibiani and Newmont's Ahafo mine, are obviously as you start to get deeper and into those sulfides. So it's something we're really excited about.
Right, and what are you seeing there in terms of these deeper drilling at Niam, for instance? Are you seeing a consistency of this higher grade mineralization at depth?
Yeah, one of the key things is identifying where these high grade feeder zones exist. So again, if you go to our presentation, we've got a nice long section of the Chirano mine. We then compare it to our project, and if you look closely, you'll see that these feeder zones don't exist everywhere at Chirano, nor do they at Bibiani or Ahafo. One of the advantages we have at Newcore and our shareholders have is the fact that we've done over 200,000 meters of drilling on the project. So we can leverage all of the data that's come out of that 200,000 meters of drilling. We've now very clearly, and you can go onto our website and play with our 3D model, you can very clearly start to see where a number of these high-grade feeder zones sit on our project. And it's a matter of us obviously getting back in there, doing additional drilling to look to extend those along strike as well as at depth. So it's really, getting back in there and drilling, but we have started to already identify these areas. We even put out a small underground resource of 136,000 ounces. And for us, that's obviously not a mine today, but what it is it's a proof of concept. It shows that we do have these high-grade feeder zones, and with additional drilling, we think we'll be able to grow the overall size of those feeder zones. So again, it's something we're really excited about and something we're eager to go and do follow-up drilling on.
Right, I'm intrigued as to where the money came from, and what you said to them and what their expectations are, because obviously you kind of referenced some of the existing deposits in the region, such as Bibiani and Chirano and Ahafo, etc. But how are you able to say, look, we will spend your money wisely and efficiently in terms of identify targets and, what those geological indicators are and, and how we're going to get after this stuff. Or if you kind of played it safe and say, look, we'll do some infill drilling, get the resource up to a certain size, and that will kind of create some immediate value for you. Can you kind of break down the drill planning, as it were, and where the kind of certainty comes from?
Yeah, so Matt, I guess if we take a step back, fundamentally, to create a significant re-rate for shareholders, we don't need to find another ounce on the project, and we can create a fundamental re-rate for investors. Sure, let's infill drilling. Sure, you're finding ounces, but if you take our existing resource today, you assume a large percentage of that's going to get converted with the infill resource conversion. We don't need to find another ounce on the project to create a significant re-rate for investors. If you look at the PEA that we put out, we're now moving towards a PFS. At a $2,350 gold price, you're looking at an after-tax NPV of $630 million US. After-tax IRR of 92% and a 1.1-year payback. You compare that to our market cap today, which sits around $70 million US. So we're trading at about 0.1, 0.15 times the NPV of the project that we've outlined today. Our institutional investors and the new incoming fundamental long-only investors that have come in, they recognize, and their view is that our project today is being undervalued in the market. So they're fundamentally buying the project that we've got today that we're moving to a PFS. As you take a project from a PEA to a PFS, you start to look at, go pull up your analyst reports, and Matt, you can comment if you want for your viewers, but call it 0.4 to 0.6 times is typically where PFS, FS stage projects start to trade. So you look at where we are today, that's the multiple re-rate that we refer to when we look at the opportunity for shareholders and for us taking it to a PFS. And one thing, Matt, I think it's probably important to, remind your viewers is management and board at Newcore, we own 15% of the company. So we are shareholders. We're truly aligned. This is money that I've invested, our board and management has invested alongside shareholders over the last number of years. So, we see that multiple re-rate by de-risking. Beyond that is the exploration that we're talking about. So as I mentioned, end of January, for the first time in a couple of years, we actually started to see some reward coming from the market with good drill results. So that's a big part of our motivation to expand our drill program to 35,000 meters, because we can see additional outsized returns beyond that fundamental re-rate that we'll get from exploration. So that's a big part of the focus. Is we will aggressively drill. We'll get those results out. If the market continues to reward Newcore and our shareholders for that drilling, then we'll continue to keep the rigs going. But we have the flexibility to also always pull back and still create huge value for shareholders with that de-risking towards a PFS.
Okay, so I guess the thing that gives me comfort in this, that the PEA is from 2024, is that right?
Correct.
Yep.
Mid-2024 is when we published it.
Right, so I guess it's relatively up to date in terms of the cost exercise. Not that it's a high capital cost project. We're talking about slightly over $100 million here, and there's a lot of things working in your favor. The gold price, etc. But just in terms of some of the things, when you move from PEA to PFS, there's expectation that the resource grows in there, and therefore presumably economics should improve as well. But what are the things that you kind of particularly getting the team to hone in on in terms of those not just capital efficiencies, but process efficiencies, which kind of drive that bottom line?
Again, Matt, I obviously optimization is something that you always look at, but if we go through the economics of the project again, $2,350 gold, $630 million after-tax NPV, 92% IRR, 1.1 year payback. Those numbers as they stand today are phenomenal and warrant us putting this project into production. So yes, if we can optimize around the edges, great. But one of the advantages we have is we don't need to do much optimization work. If we can replicate close to what we put out in the PEA, we think that will create huge value for shareholders. To answer your question from a de-risking perspective, there are aspects that obviously need to be completed to move from PEA to PFS. One of those things that we've talked about a bunch already is resource conversion. So today we have 740,000 ounces of indicated, 74,000 ounces of inferred. We need to convert about 550,000 ounces from the inferred category into the indicated category. That will take us to 1.3 million ounces. So with the drilling that we've released thus far, a lot of that has moved us well along that path of getting towards that 1.3 million ounces of indicated. So we're feeling very comfortable from a conversion perspective. Beyond that, there's things like hydrological test work, condemnation drilling, geotech work. We're doing a little bit of additional metallurgical test work as well. So all of that's happening in the background, and those are all aspects that need to be ticked off to, again, de-risk the project from PEA to PFS, and that's something that we're ultimately focused on, with the goal of commissioning the PFS in the second half of this year and having it released in the first half of 2026.
Right. Okay. I get that. Like, if you just hit the kind of current figures or thereabout, life is good. But I always look to ways that you can drive those efficiencies, because then it becomes quite exceptional, like an exceptional project.
Yeah, so small example, if we want to get into specifics on efficiency, because absolutely it's something that we will focus on, and we want to eke out as much as we can. We were relatively conservative in the PEA, and that was deliberate. The economics were such that we're very mindful that as you move to PFS, additional costs creep in. So we want to have levers to be able to pull, as we move to a PFS, to be able to offset those costs, so on and so forth. Again, when you have 92% IRR, you don't need to be aggressive. When you're in the teens or even in the 20s, from a IRR perspective, that's when companies need to start getting aggressive, and we did not need to do that. Small example, just because you asked the question, again, crushers, for example. We're assuming that 50% of the transitional material will need to be crushed. So as a result, we're paying for crushers in year 4 and 5, which amounts to 57 million total, 30 million in year 4, 27 million in year 5. If you and I were standing in the core shack today and looking at the core, you would pretty clearly see that most likely we'll probably only need to crush 20% of the transitional material. So what'll happen is we'll be able to push that, CapEx for the crushers out to, let's say, years 5 and 6 or years 6 and 7. That obviously then, helps from an NPV perspective, helps from an IRR perspective, because anytime you push capital costs out, that benefits you. The other reality is with all of the drilling that we're doing right now and that we anticipate continuing to do as we move to a construction decision, we expect that we'll find additional oxides. We expect that we'll find additional transitional materials. So the mine plan then ultimately changes over time as well. So, there's lots of different levers that we can and will pull. And I'd use that as just one small example in terms of, efficiencies that we're looking at as we move from PEA to PFS. Metallurgical recoveries would be another area that we'll look at. So all of those different things, yes, we are looking at all of those. But again, it's not something our project needs to justify putting it into production, which I think is a key differentiator from a lot of the other studies that you see out there.
Okay, no, I think you're answering a lot of the questions that we had, certainly around the delayed crusher installation, etc. But one thing it didn't kind of cover in there was, and we've seen this in parts of West Africa where they've had sort of challenges achieving kind of consistency of recovery rates, given the kind of ore variability, sometimes not even being able to distinguish between waste and ore. So, how are you looking at that?
Yeah, again, one of the advantages, if you look at our resources, the gold is very well disseminated through the entire ore body. So we're not 210,000 meters of drilling, we haven't had one visible gold intercept to date. So again, that highlights the fact that typically the the mineralization is and the gold is very well disseminated through the entire ore body. So, we don't have that same kind of issue around, high grade areas and where there's a real clear distinction between, ore and waste. So, that's something that's obviously helpful for our project as well. And again, lends itself very well to a simple open pit heap leach operation.
Okay, and I guess in all of this, you'll be able to kind of answer one of the kind of, I guess, banking questions, which is in terms of the life of mine, that looks almost certain to extend from where the kind of 9-year life of mine where it stands now.
Yeah, so as we talked about a little bit from an exploration perspective, our deposits do remain open along strike. So systematically stepping out, adding near surface, ounces is something that would then, help expand the overall mine life. Previously drill tested areas, up to the north, Arati, Cogita Hill, Naquanta, CU South. These are all areas where we've made discoveries as part of this 210,000 meters that's been completed on the project. And we'll go back to those areas, look to grow the mineralized footprint at those areas, then look to wrap a resource around them, which then obviously goes and extends mine life. And then, as I alluded to, as we grow the overall size of the sulfide resource and we, start to build on the number of ounces there will be a point where, in my view, it'll make sense to put in a CIL plant. That then becomes a real step change for the project. So you now take in, let's say, the mine life from 9 years of heap leach to, let's say, 12 to 15 years of heap leach. You've built up the sulfide, resource to a couple million ounces, let's say. Now, a couple million ounces at, 100,000 ounces of production a year. You're all of a sudden justifying putting in a CIL plant. That then takes your production profile, let's say, from 120,000 ounces to 200 to 250,000 ounces. So, that's the kind of, path that I can see, obviously, for the company. Listen, very forward looking, all the rest of it, huge amount of work that needs to be done to get us to that point. But it's one of the, again, things that really excites me and big component of the optionality that this project creates. But get rid of all of that. The project that we identified and laid out within the 2024 PEA that we're moving to a PFS today is an extremely robust project that warrants going into production without one more ounce being discovered on the project.
I get the message loud and clear. Look, that mine scheduling and sequencing is important, and the optionality of moving from 120,000 ounces to 250,000 ounces, great. What I'm trying to understand is, like, to what end, right? So is this something, given the capex and presumably the opex is not insignificant? I suspect the money will be there for you when you need it. Is this something, because money will be cheaper, it will be available, that you feel that you guys, if you can bring the right team on board, can do yourself? Or do you think you need to eventually kind of build the profile of the what could be in a DFS, that's someone else, a major, it may be more interesting for a major, in which case it's going to have to grow, not necessarily in terms of ounces per year, but in terms of that resource and potential reserve size?
Yeah, so a couple things to unpack there, and maybe I'll start with the CapEx and the ability for us to put it into production. And then I think the second part of your question is surrounding M&A and potential interest from groups and all the rest of it. So let's start with the first part of your question, which is, the ability for us to put it into production. So if we look at the CapEx, which you referred to as low, to put a number on it, what we outlined in the PEA, $106 million of CapEx. If you look at our institutional shareholder list, we can more than fund the equity portion of the CapEx for to put the project into production. With our board and team involved today, we can absolutely bring in the build team required to then take it to build it and then ultimately put it into production and run the project. That's something that our institutional investors have mandated us to go and do and are extremely excited about. they see, us being able to put this project into production within 3 or 4 years, which is unheard of when you look at a lot of other projects around the world in terms of, jurisdictions, permitting processes, timelines, all the rest of it. So it's one of the big advantages we have is the ability to fast track this into production. And it's something that our major shareholders want us to ultimately do. If you look at the cash flow that's then generated at a $2,350 gold price, you're looking at $855 million of after-tax cash flow that's generated over a 9-year mine life. Year 1, about $100 million. Year 2, just over $100 million. Year 3, $90 million of after-tax cash flow. You look at that cash flow generation, and at that point, you've created a self-sustaining district-scale exploration project. Our Enchi project could, withstand 1 million meters of drilling. So that's one of the things that our institutional investors are extremely excited about, is us getting it into production and generating as much cash flow as we possibly can. Second part of your question, I think, surrounds M&A and talking about, majors and acquirers and all the rest of it. You look at the production profile of our project, 120,000 ounces, 122,000 ounces over a 9-year mine life. That is a very attractive production profile, not for a major. The Newmonts, the Goldfields, the, Anglos of the world, they're looking for 250,000 ounce plus, per year projects. So we may not today fit into that category. Yes, as we grow this to a 5 million ounce plus deposit, that's when they start to get interested. There's another group of companies out there, that are, let's call it single asset companies that maybe produce somewhere between 100 and 200,000 ounces of production, or maybe have 2 assets that are sitting around 250 to 400,000 ounces of production, where 120,000 ounces of production in Ghana, which is a tier 1 jurisdiction, very politically good jurisdiction to be operating, safe from a security perspective, that generates a huge amount of after-tax cash flow. Our Enchi project is the kind of project that would fit very well for those types of groups. So inevitably, yes, as we move this from PEA to PFS to FS and we put it into production, the probability of someone coming along and saying, hey, we want to buy this project increases along that entire path. But the beauty is we do not need that as an outcome. When you look at so many other projects in other jurisdictions around the world, the only outcome for them is someone buys them. And that is not a favorable position to be in my view. One of the things I like the most about our project is the optionality. We've got the optionality to build it. We've got the optionality that someone comes along and takes us out. And layered on top of all of that, we've got true district scale exploration optionality. So all of that combined, I think, is extremely unique to find in a company of our size. Did you cover it, Matt?
Yeah, it does, but I just kind of want to go a little bit deeper, if you don't mind, because there's been a lot of M&A, obviously some pretty big M&A across Africa and the Middle East, and there seems to be this sort of new money coming in. You've got the usual kind of Chinese players coming in, picking up big projects, but we're also seeing a little bit of money coming out of the Middle East. People are quite excited about what's happening in Riyadh, down in Dubai and places like that. Do you think there's going to be new types of money having to come into the space to just kind of keep the mining dream alive, as it were, because as retail sort of floods out?
I mean, I think all of the money that you just referred to is focusing on Africa because they recognize it's a jurisdiction that's open for business. I mean, if any of your listeners were at the Spotlight on Ghana event that was hosted during the PDAC conference, the Minister of Mines, the new Minister of Mines, who was appointed early January, stood up and said, Ghana's open for business, and went through all the reasons why it's such a favorable jurisdiction to be operating in. And if you look at the Chinese and a lot of the acquisitions that they've made, they've been focused on Africa. And that's been the case for a number of years. You look at Osino, for example, they got taken out by Yin Tai, which has now changed their names. That project got taken out for about 0.6 times the NPV of the project. Tieto, another one that recently got taken out by the Chinese. So we've got lots of examples of the Chinese coming in Africa more broadly, but then specifically, if we look at Ghana, it's been a go-to jurisdiction. Golden Star, Wassa got bought by Chifeng, large Chinese company. You then had a bidding war for Cardinal Resources, which has the Nandini project up in the northern part of the country. That was a bidding war between Nord Gold and Shandong. Shandong eventually ended up winning that bid. And, fast forward 3 years later, they've actually put the Nandini project into production in Q4 of last year, 350,000 ounces of production. So huge project that they were able to get built within 3 years, which I think, again, speaks to, Ghana as a great jurisdiction to ultimately build projects, but also to operate projects. And then most recently, we've got Zijin, who's come into Ghana, and they bought Newmont's non-core asset, the Akim asset. They paid $1 billion for that project, which again, I think speaks to the desire to get into the country, but also the long life opportunity that these projects have in Ghana. You're not spending $1 billion on a project if you think it's only got a 5 or 10 year mine life. So they've got a view that this is a long life asset that they will be able to run and manage for a number of years. So specifically on your comment about the Chinese, Chifeng, Shandong, Zijin have all aggressively come into Ghana in the last few years. And more broadly, we've obviously seen the Chinese very active in West Africa, as well as Africa as a whole.
Exciting times to be a developer, Luke. Exciting times indeed. Well, I'm
great
to get
maybe speaking on that front, Matt. When you look at Newcore and our Enchi project in Ghana from a development perspective, and you look at the country as a whole, you've got 5 million ounces of production in Ghana, which makes it the largest gold producer in Africa. Globally, it's the 6th largest gold producer, just behind Canada and the U.S. So there's a huge amount of talent in country, and lots of mines that are run by the mid-caps and majors. You currently have 3 of the top 10 largest gold producers on the planet: Newmont, Goldfields, Anglo Gold. As I mentioned, you've now got Zijin coming into the country in a big way. So you've got this huge amount of production from the majors and mid-caps in Ghana. There's then a bit of a dearth between the producers and the developers. Newcore and our Enchi project is one of the top 2 most advanced projects, greenfield projects in the country from a development perspective. So it's one of the things that we're very excited about. It's also one of the things that the government's excited about. They see the path to another mine being built and all the benefits that ultimately come from that. So, we're very well positioned in the country in terms of where we sit from a development perspective and where that ranks as a project in Ghana. So sorry to interrupt. I just thought it was important to highlight that point as well.
No, for sure. And I guess for people who don't understand, so West Africa, or maybe not done business in Ghana, it's kind of important to point out the environment, the jurisdiction, the ability to do mining there. There's a lot of mining companies, a lot of big mining companies there. And for you guys, obviously, you've got a good relationship with them, being able to kind of keep the project moving along. But what are you seeing? What's happening in country? Because I think and reason what I want you to address is, maybe if people are looking up towards Mali or Niger, and these things are, hundreds, if not thousands of kilometers away, but, they perhaps have a slightly different view of West Africa. For you, Ghana looks like what?
I mean, the way I always approached it, from a personal perspective, and I think this is a good, first lens for anyone who's looking at a mining company or a jurisdiction is, first pass, 20,000 feet, look at who's operating in the country and look at what kind of capital they've deployed. So again, Newmont, Goldfields, Anglo, they all have significant operations in Ghana. Zijin is coming into the country. Newmont is investing another $1 billion into their Ahafo North project, which again sits along the Sefwi Bibiani belt to the north of us, which I've talked about a couple of times on this call. You're not going to find another country in Africa and potentially globally, or it'd be up there globally, where you have so many major mining companies focused on one jurisdiction. So again, as a first pass, I think that, is a good place to start, is follow where the major mining companies. I mean, to put it in perspective, all of those major companies that I mentioned would have larger political risk and security risk teams than our entire company combined. And they can deploy capital in any jurisdiction on the planet and have business development teams combing over every single country and every single project and asset out there. And they've decided to invest that kind of capital into Ghana. Newmont, once they've completed this Ahafo North expansion, it's going to take that project to over 1 million ounces of production and is going to make it the second largest producing mine in their entire portfolio, which again, I think speaks to, the quality of the jurisdiction. They're not going to be spending that kind of capital if they're not 100% comfortable with the jurisdiction. So, you then dive down a little bit into it. Free and fair elections, if you go look at the various, groups who monitor elections globally, there's been free and fair elections for, the last 30 plus years. Security-wise, when we're in country, we hop in a vehicle and drive across the country, without any securities, no issues at all. The government's very well aligned in terms of, wanting to see the industry grow. I think the great example of that is the Shandong example I just used. They bought that project 3 years ago. Huge project, is now in production, 350,000 ounces per year. So you add all of those things up, and I think it really highlights that Ghana is a great place to be, and the reason why you've got so many major mining companies there. For us at Newcore, it means we could leverage all of that off of all of that well-trained talent that there is in country, and we're very fortunate to have amassed such a large land package when we did, and been able to aggressively move it forward the way we have over the last number of years.